friends and family, you can start there, but I can tell you, I always tell entrepreneurs, be cautious. When I was very new in the business, a good friend of mine told me that if you ever wanted to enjoy Thanksgiving dinner, don't invest family money. Because again, you think it's easy money to get, but the strings are a lot bigger. And so you have to be careful with that. And I always caution entrepreneurs to, if they can avoid it, avoid it. But if they can't, make sure they're very clear about the risk.
Hello, Scott. Welcome to Lazy Entrepreneur Podcast. I'm so excited to interview you today because I just feel like you have a lot of wisdom and insights that you can add value to our listeners today. But before we dig deeper onto the topic that we're going to be talking about today, I want you to introduce yourself to our listeners.
Great. Thanks for having me. Yeah, a backgrounder about me. I've been, I guess what you call a deal guy for about 35 years or so. I started working on the floor of the New York Stock Exchange in the early 80s, moved to San Francisco in 1986, worked as an investment banker, taking tech companies public on the stock exchange. In 93, I became a founder for the first time. I launched my first internet company. I was able to successfully launch that and two other companies and exit those companies between 93 and 2000. 2000, I retired briefly, moved to Arizona. After a brief stint in retirement, I started another company in entertainment and sports and sold that 6 years later. And that's when I launched Black Dog Venture Partners. And what we do at Black Dog Venture Partners is really three things: help tech startups and entrepreneurs in general fund, scale, and exit their business. So since that time, we raised about $5 billion for these companies, helped 30 of them exit during that time. And we also host events around the country. I'm the host of VC Fast Pitch, which puts entrepreneurs in front of investors. We do both online and in-person events around the country, and we raised $130 million from those events. 3 years ago, I moved from Arizona to St. Pete, Florida. And last year, I launched the Emerging Managers podcast, where I interview venture capital firms. So that's me.
That's amazing. Wow. You have quite a lot of experience, when it comes to starting and exiting a business and helping startups get the funding that they need to grow their business. So I want to talk to you about, the businesses that you built and you sold. And so you said in 2000, you exited a business and then you retired and then you started another business. And then after 6 years, you sold the entertainment and sports business. So that's pretty much the last business that you started and then you sold.
On my own. We've actually
before Black,
obviously.
Before Black Venture. Yeah. So and so the previous company that you sold was in 2000, and the entertainment and sports business, what year did you sell that business?
I sold that in 2006, and then actually it was three companies that I launched and sold before 2000. So I had one company that was the first online mortgage company, before everyone had the internet. We had a marketing company that we sold in the 90s. And then we had another company that was in the music space that we sold.
Yeah, interesting. So during the first time that you sold your first business, what are the lessons that you've learned? I'm pretty sure, when you do something the first time, right, you're kind of like, okay, I'm not really sure what to do. I mean, you may know what to do during that time, but what are the lessons that you've learned that you wish you knew before you sell your first business?
Yeah, I think probably the main lesson was to understand that I was going to sell the business. Because honestly, when I launched that first business, I just thought I would do it forever. And then an opportunity to sell it came about. And so a lot of entrepreneurs, I tell them, especially if you're going to raise capital, you have to think about the end. And I didn't think about the end that first time out. And so, I didn't build the business to sell. And that was probably the biggest lesson I learned. And I think the reality is entrepreneurs have to decide if they're going to build the business to keep it or build the business to sell it. And that was probably the biggest lesson I had to learn.
Wow, which is very true, because when you start a business, you're pretty much very focused on the revenue, right? Like growing it, making sure that you pay yourself enough to live, and thinking about exiting your business. Sometimes that happens when you're in the thick of it, right? When you're frustrated about the business, when you're like when you're so down and depressed because of all the problems that you've encountered in the business. And so now that you help startups, scale their business, is that something that you teach them, getting ready to exit?
Absolutely. So basically, what happens is when a company comes to us and, they really have a couple of needs. One, they may need to raise money to grow their business. Two, they need to grow their business. And then three, they need to figure out how to exit that business. So we sit down with them and really kind of examine those three things, and then, create a plan and take the steps necessary. So for example, if a company wants to raise capital, we'll help them prepare their pitch deck and their deal room and their due diligence materials, and then help put them in front of the right investor. If they want to grow their business, we'll put together a strategic plan to reach their customers or reach distribution or other partners. And then when it's time to exit, we'll begin to research who those potential acquirers are and then help negotiate that transaction.
Interesting. And so you focus on helping startups. Define startups for us, for our listeners.
I'm glad you mentioned that, because startups is, an interesting term.
Right.
I think I always have a challenge. I like to call them small businesses or just businesses. I think sometimes startups are in the business of raising money, and you don't always have to raise money. A business in the business of making a profit. And I think, so a startup has a wide range. You watch the news today, and there's startups that are raising hundreds of millions or billions of dollars, and they're not startups. And startups is generally a term used for where a company is in their fundraising cycle. Whether they have either raised capital or they raised their first round of capital. So a lot of the startups that I work with are primarily technology startups, and they have some startup expense, so they obviously have to raise capital. But I like to call them entrepreneurs or businesses as opposed to startups, because I tell entrepreneurs all the time, build the business first, and then try to raise capital. But the reality is that's not always possible, and it's not always the case.
Right. Yeah. So, meaning startups, not necessarily for SaaS industry only. It's only applicable to service-based.
Absolutely. Any business that's just getting off the ground, more or less, is defined as startups.
All right. Yeah, that's good. I'm glad we clarify that so that I know what I need to ask you next. Okay. So, when I started my business, I, used my own money. I bootstrap it. I tried my best not to take out loans from the bank or, SBA loan, or even, ask investors to invest in my business. And that is mainly because they say that, if you have investors, then you're not really going to be like the 100% boss of your business. Yes, you may own the business, but you have another boss to report to and explain to them,
right,
your income, your expenses, and your profit. And so, what do you think of that?
No, you're 100% right. Because the reality is, when you bring on an investor, you also bring on an opinion, and it might not be the same opinion. And you have to be really careful about that. I tell entrepreneurs all the time that an investor may be doing due diligence on you, but you should be doing due diligence on them to make sure it's the right fit. Because in all honesty, a no investor is better than a bad investor. And so I think it's very important that you look at that from that standpoint. And I agree. I think the vast majority of businesses should be like yourself: bootstrap, grow it. The best way to raise capital is to sell your product or service, and stick with that. But again, obviously, some businesses do require capital, but there is some downside along with the upside.
Right. Yeah, that's so true. Okay. And for those businesses who want to look for investors to fund their venture, what are the things that they need to consider or think about before pitching to investors?
Yeah, the most important thing, the two things you need to do is build a list of relationships and have all your ducks in a line from a due diligence standpoint. And what I mean by that is, I get entrepreneurs that ask me, okay, when should I start speaking to investors? And I tell them 6 months before you go raise money. And the reality is raising money is a very long, hard business. And you need to, like any sales, you need to build your funnel. You need to build a network of investors that invest in your industry, invest in your stage of development, and maybe even have a good strategic fit for your business. So I tell entrepreneurs they should be spending 6 months or more building at least a network of 200 investors that fit their criteria before they even pitch them for investors. Because again, you want to make sure you're efficient about your time, and you want to make sure that you're pitching the right investor. And then it really comes down to being prepared ahead of time. It usually starts with a pitch deck, which is basically a 12 to 15 slide presentation of your company that goes over your problem, solution, your team, your go-to-market, and everything else. But then there's more information that's needed. Investors want to know as much as they can about you. They want to know the resumes of the founders. They want to know your financials, your current financials, your pro forma financials. They want to know what kind of technology or intellectual property that you have. They're going to do a deep dive because, the reality is that most people know that 90% of startups fail in the first couple of years. 75% of companies that raise venture capital fail. So it's a high risk business, and you need to be able to convince these investors that you've done the homework to make sure that the risk is justified.
Right. Yeah. And you mentioned earlier they need to prepare for due diligence. And what are those due diligence? Are those mainly financials or tools that you use, or your clients' contract and all that?
It's all of the above and more. So what you do is they're going to ask you about your clients. They're going to ask you about your competition. They're going to ask you about your marketing plan. They're going to ask you about your financials. They're going to ask you about litigation. If anyone on the team has any issues from that standpoint, they're going to want to know. They're going to do a deep dive of everything they need to know to make a decision. So it's all of those things and far more. Because the reality is it's not like they're buying a stock on the stock exchange and they can research the information. It's not public. You have to provide that information to them. So due diligence is a really important process because you have to make sure that you have proven to them that you can take your idea, execute it correctly, and turn it into a profitable business that can be sold at a profit, down the line.
Right. Yeah. In terms of financial records that you need to prepare for pitching to investors, does it need to show that you're somehow making a profit from the products that you're selling? What if you're in the negative? Because
it doesn't. You don't necessarily have to be profitable obviously that would be the goal of any business,
right?
But the reality is, if you can show a plan and your financials and your projections show how you can get profitable, that's what they're going to want to see. Because honestly, a lot of entrepreneurs, by the time they're talking to their first round of investors, they may not have any revenue, and they may not even have a product yet.
Right.
So you have to have some projections of where you can go in the future, and that's really what the investors are betting on.
Yeah, so these business owners who want to have investors to fund their business, they really need to know how to convince people, right? Like they have to sell not just the product, but also themselves, because the investor is also investing onto the business owner, right? Like the capabilities, of that business owner. And so when it comes to looking for investors? You said at least have 200 investors, right? Where do you look for those investors?
There's a lot of different resources. Obviously, you go to online resources, LinkedIn, Crunchbase, PitchBook. There's a lot of online resources where you can find and research investors. You can go to events. I find it very valuable that you go to pitch events, or you go to events where investors are attending and just get to know them, build those relationships. But probably one of the best recommendations to get an investor that would be good for you is find a similar company that's raised money and talk to them. A referral or recommendation from a startup that's raised money or another investor goes a long way. So obviously you can use online resources, go to events, incubators and accelerators, around the country have events where you can network with investors. We host events around the country to do just that. And then honestly, like I said, talk to other successful entrepreneurs and businesses in your industry that have raised money.
Right. Yeah. So there are different types of investors, right? There's angel investors. I don't know what else you call them, but I know some people, they raise money from different individuals, quote unquote, investors. So what is the best route to get funds for a business? Like, should an individual go look for an angel investor, or should they reach out to their friends and families?
Well, I think it's a combination. Typically what happens is when you're a very early stage company, you're probably not going to talk to venture capital firms because they're large firms with lots of their own investors. And they'll typically not invest until you have a certain amount of revenue or a certain stage for the most part. So typically you're going to invest with angel investors in the beginning. And those are people that have, retired or have exited their own business and are investing their own money. Friends and family, you can start there, but I can tell you, I always tell entrepreneurs, be cautious. When I was very new in the business, a good friend of mine told me that if you ever wanted to enjoy Thanksgiving dinner, don't invest family money. Because again, you think it's easy money to get, but the strings are a lot bigger. And so you have to be careful with that. And I always caution entrepreneurs to, if they can avoid it, avoid it. But if they can't, make sure they're very clear about the risk, because these are investments that could easily go to zero. And you want to make sure that you get invited for Thanksgiving dinner, in the future. So.
Right. I totally agree. Yeah. And you mentioned earlier that you need to have your ducks in a row, and then you need to have, you need to prepare your due diligence and all that. So after you have everything organized, as the business owner yourself, how do you pitch successfully? Let's say you have 12 to 15 pages of a pitch deck that is, very, very good. You have the solution, the problem, and, the future of the product and all that. But then when it comes to like actually pitching to investors, what are some of the things that they need to know?
Yeah, I think it comes down to one, practice, and two, confidence. And how you get both of those things is by doing it. And there's a lot of ways you can actually get out there and talk to people. There's all kinds of pitch events and competitions you can be a part of and get feedback. I've had companies go to, there's organizations like Million Cups that have around the country where you can pitch to, not necessarily investors, but you get to practice the pitch and get some exposure. But again, I think you also have to get in front of investors. And I tell people, I had two sons that played sports, and I said, you practice because you're eventually going to play a game, but you don't know how good you are until you play that game. And that same applies in pitching. So I think, and that's why you have to have a lot of people. You have to have a lot of shots on goal, so to speak. So, and it's important to make sure you understand the investor ahead of time and how they want to get information. Sometimes investors want you to go through the pitch slides. Sometimes they want to have just a conversation. You have to be prepared for both. I tell entrepreneurs they should probably have a 1 minute, a 5 minute, and a 20-minute pitch ready to go at all times, because you just don't know how much time you're going to get. But it's like everything else, it's practice. Part of what we do for entrepreneurs, we do a lot of pitch coaching. We make sure they're ready before they get in front of investors. But again, it's a little practice and then, get into the game.
Yeah, I love that. You learn from your mistakes, right? When you talk,
Absolutely.
when you pitch to one investor, it doesn't mean that investor is gonna get on board with you. Do you know the show Shark Tank?
Sure.
Is pitching to investors online similar to what they do on Shark Tank?
Shark Tank is very good TV. There's elements of it that are similar. And I've had companies that I've worked with that have been on that show. And it's, you might be on the television show for 5 minutes, but it's a television show. There's outtakes, there's retakes. It's a process. So it's not a bad experience, but it's TV.
Right.
And I think you have to remember that everything that happens on TV is true in real life. So.
Right. Yeah, that's true. Yeah. And so when you pitch to an investor, do you tell them how much you need from the investor, or does the investor tell you how much they can invest, and then do they set their own terms?
No, well, it's a little bit of both. You should always know what you're raising money for, because typically the end of most presentations is the ask. And what you tell investors at that point is a few things. One, if you've invested your own money, tell them that. That shows commitment. If others have invested, tell them that. Tell them there's other interest. But then when you need to do a couple things when you're asking for the capital. One, be specific about the amount. Be detailed of what you're going to use the money for, and then let them know what milestones you're going to accomplish in what time frame after you raise that capital. Because it's really important for investors to know that not only have you built a business, but you also know how to properly manage and spend your money to maximize results.
Right.
And that's what's really important. So now that said, after you ask for that money and ask what you want it for, they may come back with their own terms, and then it's a negotiation process after that.
Right. Yeah. Wow. It is definitely a long process, but I'm sure it's worth it, at the end. So, all right, let's say you have an investor willing to invest in your business. What happens after that? You have the money, let's say $50,000.
Mhm.
So do you have to report to the investor every month, or do you have a meeting like weekly? How does it work?
Well, again, typically you're not always required, but I highly recommend it. It's very important to keep your investors up to date on an ongoing basis. And whether that's monthly or quarterly, I think it's very important to not just share the good news, share the bad news, because you don't want to wait till you get to a point where it's too late before you contact investors. So you have to establish that trust relationship, not even before the investment, but after the investment, because one, they're taking a large risk. Two, you have a responsibility now as their fellow owner in the company to report to them. But again, reporting comes in a couple of different ways. Sometimes it's via email. We typically have companies that will send at least a monthly update, and then typically have a quarterly or at least twice a year phone call with the investors. I think it's important because it's not only is it important to keep them up to date, you don't know that down the line you might need more capital. And if you keep that communication line going, they may be able to, invest again.
Right. Yeah, that makes sense. So do investors kind of like work like a bank where they give you interest rate on the money that they're gonna invest in you, or are they gonna ask for a portion of your business? Like, okay, I'm gonna own 5% or 10% of your business.
It's typically the latter. They're investing in equity for the most part.
Okay.
Now, it's not to say there can't be a debt portion of it, or they may invest it as a loan. But the vast majority of angels and venture capital firms are investing in equity in the company and the ownership in the company. So they're hoping that, they invest in X amount of money, and in 5, 7, 10 years, they get X amount of money multiplied, several times.
Right. Cool. And when you built your businesses, did you ever pitch to an investor or partner with investors?
But that's the irony. I help entrepreneurs raise capital and talk to investors all the time. I never raised money for my own company.
Okay.
I self-funded my own company. And that's what I've been doing up to this point. I mean, I've had this company for 30 or almost 30 years now, and I have never raised any outside capital. And I own 100% of my business.
That's good.
And that obviously gives you freedom.
Yeah.
I've had offers, but I made a decision to run it myself. I tell people I'm a bad employee, so I might as well just own 100% of the company.
Right.
And honestly, for entrepreneurs, it's a real decision you have to make. It's
like selling a portion of your business.
It is selling a portion of your business, and and there's consequences, good and bad, to do that. So you really have to dig deep and say, okay, can I grow slower and have all the control, or do I want to go faster and lose some of the control?
Right. Yeah. And so as part of as part of the services that you offer to, startups or entrepreneurs, you also help them, figure out how they can manage their money in the business so they don't have to look for investors and they can bootstrap their own business.
Yeah, typically what happens is we'll work with them really from the startup phase all the way until they get to an exit in a lot of cases. So in some cases, in the beginning, we are doing a lot of things. We're obviously helping them prepare, get in front of investors. We're actually helping them build sales channels and partnerships and relationships to sell their product and service. We're helping them build their team, adding other members of the team that have expertise in other areas that the founder may not have. And then obviously as the business grows, we spend more time advising and helping and less time actually doing.
All right, cool. Awesome. Well, as we wrap up, I have a few questions for you still before we end. But speaking of, pitching into investors, what is that one thing a business owner need to keep in mind when pitching to an investor that if they do or don't do, it will cost them a lot?
They have to understand the mindset of the investor. So typically, for example, a venture capital firm, a company that makes millions of dollars in multiple companies in investment, they will typically, if they make 10 investments, 8 or 9 of them will go to completely zero. So they're really counting on one investment, maybe 2, getting the money back to their investors and getting a good return on that money. So you have to understand that investors, especially if they're investing other people's money, like a venture capital firm, they're accountable to their investors. And so if you understand that mindset, then you'll have a better handle on how to give them the investors confidence that not only can you get their money back, but you can get them a return on your money. And that's really important. I think you have to have that mindset. You have to understand it. This is not a gift. This is not, a lottery ticket. This is a commitment.
Right.
And I think it's very important for entrepreneurs to understand the mindset of investors, because investors will see, me included, I'll see 100 pitch decks a month in my inbox. I probably take 6 phone calls a month. So the reality is, you have to have a really good reason why you're better than anybody else, and why your team can give you the investor the highest likelihood of making a profit.
Wow, that's really, really good. And that's very helpful to our listeners, So my previous guest actually left you a question.
Okay.
And I love this question, and I'm eager to hear your answer to this question. So, how do you keep perfection from being the enemy of progress?
It's interesting that's an interesting question because I tell people all the time, you know, um, don't step over great to get to perfection, as a phrase. And I think it's important that, especially as an entrepreneur, you're always going to pivot. The business you start today may not be the business you end up with.
Right.
Let's use, Jeff Bezos from Amazon. Okay. He sold books for many, many years. All he did was sell books, nothing else. And now he has, obviously, a almost multi-trillion dollar business, because he expanded on that. So I think, and the reality is there's a really great, story I learned when I was in college and taught, also shared when I was a professor, was, McDonald's, for example. They back in the day, they would spend $500,000 researching where to put a McDonald's. Burger King, their number one competitor, waited for the McDonald's to go up and put one within the 2-mile radius. Okay. And so what I mean by that is that let the market tell you how to change your business. I think, and it's a really good question because entrepreneurs spend a lot of time building something and less time finding out if it's something, what they build is worth buying.
Right.
And that's where, getting to great and is not a bad path on the route to perfection.
Yeah, I love that. Yeah, I love that example. When McDonald's, open a store in a specific location, and then Burger King also opened within 2-mile radius. Yeah, that's cool. All right. Well, Scott, what question do you want me to ask my next guest?
The next guest, I want them to answer this question. How do you handle failure? And what do you do to overcome that failure? Wow,
that's deep. Okay, you better listen to the next episode after your episode because this is going to be good. All right, well, Scott, thank you so much for having a conversation with me today. I learned a lot from you today, and I'm pretty sure that our listeners are learning a lot as well. So, any last words of wisdom you want to leave before we end this episode?
Only last word of wisdom is I would tell you that, being an entrepreneur is hard work, has a lot of risk, a lot of failure. Be willing. I tell my piece of recommendation is be confident and be humble. Love success, love failure better.
Wow, that's gold. Thank you so much, Scott. Where can people find you online?
You can reach me at blackdogventurepartners.com. If you want to pitch at one of our events, you can go to vcfastpitch.com. I am on all social media channels at Black Dog CEO.
I love it. I'm going to include those links into our show notes so that people can visit your website and join your virtual pitch event for startups who want to pitch to investors. But thank you so much, Scott. I appreciate your time.
My pleasure, Kristy. Thanks for having me.